CharlesRMorris, The $2 Trillion Meltdown, Easy Money, High Rollers, and the Great Credit Crash. Dive into the thrilling account of the $2 Trillion Meltdown, Easy Money, High Rollers, and the Great Credit Crash, an enlightening analysis of the factors that led to the 2008 financial crisis. Learn how poor economic management, flawed financial models, and misguided deregulation intensified the recession and exposed hidden structural flaws. Morris provides thought-provoking insights into why America's financial system appeared to follow Japan's economic misfortunes of the 1980s and highlights key lessons from the Volcker era, including the importance of decisive and tenacious action. This summary equips you with a clearer understanding of what led to the credit crash and how better policies could have potentially averted this economic disaster.
Two roads of financial crisis response. In the wake of the mortgage crisis of 2007, central banks struggled to contain economic fallout from the collapse of complex mortgage-backed securities, which experts couldn't predict. The response of central banks in North America and Europe was to open the money spigot, but it was to little avail. History presented two roads that policymakers could choose. Former Federal Reserve Chairman Paul Volcker took the first road in the late 1970s and early 1980s when he addressed the challenge of wringing inflation out of the U.S. economy, restoring confidence in America's financial institutions. Japan took the second road after the collapse of its 1980s bubble. Japan concealed its problems, avoided responsibility, and failed to take corrective actions. As a result, Japan's financial system still has not fully recovered. In the face of the mortgage crisis, America appears to be following Japan's approach. America's economic misery in the 1970s. From 1973 to 1982, the U.S. experienced a decade of stagflation and subpar economic growth due to business failures, demographic changes, and poor economic management. Companies focused on market-sharing arrangements rather than technological innovation and became unwieldy conglomerates. The abundance of young, unskilled labor led to lower wages, less investment, and cheap capital. Inflation soared in the early 70s, followed by a collapsing currency in double-digit inflation. President Nixon's attempts to control wages and prices and increase monetary supply did more harm than good. As a result, faith in the government's ability to manage the economy faded, paving the way for a new economic ideology. The Fallacy of Correlation. The popular Chicago School economics ideology, advocating for free markets, was accepted by America in the late 1970s. The mistaken belief of the resulting investment boom following a tax cut was established, which eventually led to a powerful financial sector. The correlation between Reagan's decontrol of oil prices and subsequent gasoline price drop was also a misconception. In reality, it was due to increased energy efficiency that lessened the demand for oil. Hence, the idea of correlation equaling causation is a false one, and economics should be viewed without such fallacies. Volcker's War on Inflation. Paul Volcker's tenure as the Fed chair aimed to combat inflation and stabilize the financial system. Despite committing to the monetarist theory, which advocated controlling inflation by managing the money supply, the Federal Reserve Open Market Committee struggled to define what constituted money due to new financial instruments. Regardless, Volcker's public announcement and aggressive use of various levers brought down inflation rates, leading to a recession that Americans accepted as the cost of a stable financial future. Presidents take more credit. Presidents tend to take undue credit for good economic times, but the truth is Reagan's legacy of lowering taxes and deregulating markets has both benefits and risks. The boom in leveraged buyouts was beneficial for corporate cleansing in the beginning but went out of hand and crashed the market later on. Similarly, the economic boom in the 1990s, for which President Clinton and his team claimed credit, was a result of demographics and advancements in technology. The dot-com bubble then followed. These crises suggest that while market forces are helpful for creative destruction, deregulation bears associated risks. The mismanagement of deregulation can lead to painful debacles that turn into tragedies that take years to recover from. Premonitions of the 2007 Financial Crisis. A series of crises in the 1980s and 1990s foreshadowed the 2007 financial crisis, due to unchecked financial innovation driven by complex models. Portfolio insurance, collateralized mortgage obligations, and long-term capital management hedge fund were all created to increase profits. Portfolio insurance allowed major investors to sell stock index futures, but since most investors were using the same models, the market decline was magnified rather than protected. Collateralized mortgage obligations transformed mortgages into bond-like securities with high returns at high risk. These new securities left behind risky residuals, called toxic waste. Hedge fund investors specialized in high-return, high-risk toxic waste securities, and when the market crashed due to unrealistic predicted values, it stalled the mortgage market for years. Long-term capital management, a hedge fund with elaborate models and investors from major banks, failed miserably, putting the entire financial system at risk. These crises began in market niches that were not regulated, and led to enormous losses, hurting the public. The cost of worshipping the free market. The consequences of America's faith in the free market are examined in this book summary. The author argues that the financial crisis was caused by the deregulation of the financial services industry and the resulting tendency to bail out big firms, leading to an unsustainable buildup of debt. He points to Alan Greenspan's habit of expanding the money supply in a crisis as evidence that the United States government is out of touch with reality. The author goes on to argue that worshipping the free market has caused workers to be exploited, widened the gap between rich and poor, and led to a poorly functioning healthcare system. Finally, he takes aim at proposals to privatize Social Security, arguing that they would put more profits in the pockets of Wall Street firms while leaving pensioners at greater risk.
CharlesRMorris, The $2 Trillion Meltdown, offers essential insights into the origins and mistakes of the 2008 financial crisis. With its detailed analysis on the failure of financial models, the perils of deregulation, and the effects of poor economic management, the book raises crucial questions about America's future approach to monetary policy. By examining the lessons of both the Volcker era and Japan's economic stagnation, it underscores the need for courage, transparency, and intelligently designed regulations in order to confront future financial challenges. Equipped with the wisdom contained in this book summary, readers will be better prepared to engage in informed discussions surrounding the pitfalls and opportunities of economic policy.